As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. Hey guys, and welcome back to the channel. Today I may come across as a bit repetitive, but I want to do a new series on my YouTube channel, and that is that I want to have my thesis of all my investments out there in the public to remind me in the future, let's say a few years from now, of why I invested in the first place, and to see if my thesis were actually correct or whether or not my reasons were correct. So to start that off, I thought I'd start off with DGOC, and I'd like to give the 15 reasons why I invest in DGOC. So if this is the first time you arrived to this channel, please know that I have made a lot of videos about DGOC. In the comments below I'll leave a playlist to have my 5-part series of my whole research on DGOC, and you will find more details in there as well. So this will basically be a plain summary of the 15 reasons, and yeah, if you guys enjoy this, please let me know, and I will do so about my other 10, I think it's about 10 holdings right now, and I will create similar videos, just brief, to the point, and hopefully I'm correct in the future. So let's start off with the first reason: unique business model. So this is something that I've always repeated in all the videos, is that DGOC has a very unique business model. Instead of exploring for gas, they just acquire assets and they just milk the assets. The reason why I like this is because I think that the type of industry it's working in, like the oil and gas industry, you shouldn't be exploring that much. It has a lot of costs, and sure, it can reap a lot of benefits if you find a very high yielding field or something like that, as you've seen plenty of times in the news. But I think it comes at a cost, and especially for smaller companies, I think the price is too high, and you'd rather focus on the business itself and just acquire assets. I really like it, but obviously everyone has his own tastes in that regard. But that's one of the reasons why I invest in it. I haven't found any other company that invests in it or that runs the company in that way, but maybe there are more out there. We'll have to see in the future. The second reason is the low cost of production. So I've looked at many oil and gas companies in the US, and also a little bit further than that, and I haven't found any company besides, I think, Gazprom. It's questionable whether or not they have a lower cost of production in Russia, but I haven't found any company that has a lower cost of production for producing gas, and this creates incredible margins for them even at low gas prices. So I think that is what differentiates DGOC as well, and I think that is very attractive for investors to look into. So the cost of production is about 118, I believe, at this point, while they hedge their selling price of gas at 270, leaving us with a gross profit margin of about 55% or something like that. So that's incredibly high. Third reason is less uncertainty. So this is still related to the business model, and what I don't like about oil and gas in particular is that there's a lot of uncertainty whether or not you're going to be able to increase your production as a company. So instead of focusing on exploration and just on acquiring assets and having a decent, or actually a great, business model behind it and to protect the balance sheet and so on, but we'll get to that later, I believe that DGOC operates in this highly uncertain industry with less uncertainty. So I really like the fact that they just acquire assets. So the fourth reason is that they have a firm financial model. What do I mean with this is that they have rules in place that will protect the balance sheet, or that will ensure that they will make good financial decisions for the company. I will get to this in a bit, but I like this from a shareholder perspective because you know what to expect, and you know that they will do, well, if you understand their financial model, I guess, you will know that they will make proper decisions for the company and for shareholders. So an example of a reason is they have, and that's reason number 5, they have predetermined allocation of cash flows. So what they've done of their operational cash flow, they have said up front, okay, we're going to allocate in the following way. 40% will be used to pay off debt. 40% will be used to pay off or to pay dividends to shareholders. So that's 80% allocated already. That leaves us with 20% of operational cash flow, and that is used for capital expenditures. And if it's less than that, which tends to be the case because they have a very low capital expenditure, they use the rest for either acquiring new assets or paying or buying back shares. So that is set up front, so we actually know what they're going to do with cash flows. That brings us to reason number 6, an acceptable dividend policy. So many of you know I do not consider myself a dividend investor. I think in a way I do not consider myself a growth investor either, but if I had to choose either one of these, I would choose growth, because I do think dividends is nothing more than taking money from a company and putting it into shareholders' pocket. And if they had it in the company, since the shareholder owns that company, that value, that cash would basically be visible in the share price. Like, I do see benefits from dividends, don't get me wrong. Like if a company grows with 10% with no dividend, and there's a company that grows with 10% and 5% dividend, obviously the fact that 5% dividend is being paid is great, and that makes it a far better company than the company that has no dividends. But dividends should not affect the growth of the company. I guess that's the main point of that. But I mentioned that it is an acceptable dividend policy. So one thing that I really worry about with dividends is that companies tend to be focusing around growing dividends. Dividend growth investors, or just dividend growth in general, is considered a good thing because the shareholder gets more money. However, if that comes at a price, and price being the company is not growing at the same pace, then I consider that to be a danger for the health of the company, and I really wouldn't like that. So the fact that they have decided that 40% of the operational cash flow will be dividends, if the operational cash flow goes down, so the amount of cash that they will get in of their business operations, then the dividends will go down as well. So I do not have to worry about them paying like 80% dividends compared to the operational cash flow, which would be a bit more risky in my opinion. And you could even find examples of companies like, I think it was Exxon Mobile, who paid more dividends than their earnings. Well, I do not think that's the right comparison. It is something to be worried about when a company basically pays out more than they are earning. And finally, on this page at least, is reason number 7, and that is the protected balance sheet. So I mentioned already that they have a firm financial model, and they have firm rules in regards to the operational cash flow, but they also have a rule that will protect the balance sheet in a way that they will not use too much debt to grow. So they have a policy that their EBITDA cannot be more than 2.5 times their net debt. So how should we look at that? The moment that their earnings before interest, taxes, depreciation, amortization, otherwise known as EBITDA, the moment EBITDA grows, they can grow their balance sheet. If the EBITDA goes down, they cannot grow their balance sheet. Also, they cannot grow their balance sheet to a rate that the EBITDA will no longer be able to, or that the EBITDA will be insufficient to pay off their debt and their interest rates. So, I think everybody can decide for themselves what would be a good way to protect the balance sheet. Like, at what point or what rate would you have your net debt divided by EBITDA? Or like, what number is acceptable to you? For me personally, depending on the industry, I think the maximum would be like 3. Like net debt divided by EBITDA. I'm pretty sure that there's way worse companies out there, and they still manage with a worse net debt to EBITDA. But for a growth company, I think a maximum of 3 should be good. And the fact that they won't go over 2.5 is a positive thing to me. Then we have reason number 8. Their entire production is hedged. So sure, they have a very low cost of production, $1.18 I think it was, excluding the interest and so on. Otherwise it will be a little bit higher. But another positive point on that is that their entire production is hedged. So what does that mean? The amount they expect to produce in gas, they hedge that against a certain price. So they guarantee themselves that they can sell that gas at a rate. So you have to pay a premium for that, so you do have some extra costs, but it ensures that you can sell everything that you produce at a certain price. They have a policy that they remove the risk, but they don't remove the upside. So they don't have to sell it at that price, but they can sell it at that price. So the moment the price skyrockets, they can sell it at that price. To me, the fact that they do this gives me a lot of certainty as well, because I know that the cash flows will be steady. So I know that the dividends will be paid, and I know that debt will be paid off, so they are not at risk of, or they are not completely without risk. Every company holds the risk, but they are not at risk of going default or not being able to pay off their debt because of that. Reason number 9 is that they have experienced management, and something that I like, but maybe that's because of my background, is that most of the management have a background in finance. So I made a video about the management. It was part 4, I believe, of my research, and I listed the management and all the shareholders, and you could see that they have a lot of insider ownership. But besides that, you could see that they all have 10-20 years of experience in either this field or in a finance field, and that is something that I would like to see, because then I know that they know what they're doing from a financial perspective. And let's face it, as investors, we are dependent on the financial perspective. Not entirely, but it means a great deal. Reason number 10 is the insider ownership. So the CEO, he owns like 3% of the company. Then you have I guess he's the non-executive CEO. I guess I could just, it's not his entire title, but I'm just going to explain it like that. I forgot his title. He has another 3%. But besides that, there are, I think as of August, 7 other management members that own DGOC shares, and they are buying the shares. And recently, like the past 6 months, they have all been buying shares. I think there was not one left out that didn't buy shares in the past 6 months. So I'm not talking about bonuses. Sure, they get the bonus based on how they are performing as well, and they get that in the form of shares. But they actually use their own money to buy shares. That means 2 things. They believe in the company, and second reason is they probably think it's attractively priced. And I think it was in August, so at the price of 110 pence, we saw a new management member buying shares as well. So while I bought it at a lower price, I think, keeping in mind that they have increased their business this year, I think that 110 is still not that expensive. But you can check my previous videos on that and see how I think about it, and I'll get to that in the end of the video as well. Reason number 11, an unattractive industry. I know this might ring a few bells, like what do you mean? Well, what I mean is that oil and gas is not really a hyped industry. I think it doesn't look good on ESG investing, even though gas is pretty good from a CO2 perspective, that the output that they produce when used. But in general, it's an unattractive industry. Nobody wants to be invested in it. It doesn't have great outlook for the next 20 years, because we're all switching to electricity and so on, and we have alternatives, and we have green energy and all that. So it's unattractive. That doesn't mean that I always want to invest in unattractive industries, but if it's unattractive and it creates opportunities, then I like it, and I believe that the oil and gas industry, and the way it's looking right now, the unattractiveness is actually causing for opportunity, because I don't think we're going to get rid of that anytime soon. So that is why I do like DGOC. Attractively priced. Reason number 12, a price to free cash flow of below 5. Well, free cash flow compared to price basically tells you, okay, in how many years will I get my investment back one way or the other? So not just in dividends, but the free cash flow. What will the company return in cash, whether or not they keep it on the balance sheet or not, or pay off debt, but what will be returned to me as I buy this business? I believe it's a little bit above 3 right now, so let's say the price to free cash flow is between 3 and 4, and I believe that to be very cheap. If you look at any other company, you're going to pay a high multiple compared to that, and I think it's very important to have an attractively priced company, because if the multiple increases, let's say you have a price to free cash flow from 3 right now, and fair value would be only 6, which would still be pretty decently priced, I'd say, then the share price will double. And the opposite is true as well. If you trade at a price to free cash flow of 20, and it's 10 years from now it trades at a price to free cash flow of 10, then obviously the share price from that perspective would halve, and then it depends how much has the business grown to tell you if you had a return or a loss or not. So if you had even a profit, it would be questionable at least. So a low price to free cash flow is something that I really like. Reason number 13 is a small cap company. I do not only invest in small cap companies, but I do believe that small cap is where the growth is, and obviously it doesn't take a rocket scientist to tell you that it's more likely for a 500 million company to go to 5 billion, so let's go 10 times, than a company that's 2 trillion to go to 20 trillion. Yeah, it's just like small cap companies from a fundamental perspective tend to have more growth, like not more growth but more room to grow. So yeah, I prefer small cap companies. Obviously there's more volatility there, but and less liquidity, but small cap is where, in my opinion, the actual growth is. And I'm talking about fundamental growth there, not just the share price growth. A share can go up 400% and the underlying business has not grown at all. Tesla, for example, Apple, partially as well. So even though there is some growth there, of course, it does not account for the entire share price growth. So small cap is where the opportunities lie, in my opinion. Reason number 14, and this is something that I discovered as I studied DGOC more, is that they were going to move to the main market. This became official in May 2020, and I expect to see the results next month and the next 2 months, so September, October 2020, because they will be in the FTSE 350, which is the index of the UK market, and I believe index investors will have to buy companies like this, and as they will grow, they will only become more included in other indexes, and hopefully we'll see them in the big boys, like the all world markets, maybe a few years from now, and that will just create, because the main reason why I like them to be in an index is because people who invest in indexes, they follow the index, and the institutional investors that are taking the money to invest in these indexes, they have to buy the company regardless of the price just to hold that certain percentage. So the volume will increase that's being traded, the amount of buying that will happen for the share price will increase. So in general, I think this is a great move, and I hope to see them into the bigger boys like FTs, the FTSE 100 perhaps in the future, stuff like that. So yeah, I think this is a great move. The final reason, and this reason is going to be a bit bigger, is the growth thesis. So if you want to have my entire vision or my entire thesis about it, I've done a full video on the growth thesis, and I've explained how I see this share price go to like 6 to 9 times in the next 10 years. However, I would just like to point 3 things out for the growth thesis, and that is their dividend yield of 10% plus that we have right now. We're still having, I think, at 110 pence a share. So obviously this is not growth for the company, but it's growth for your portfolio, or for your, portfolio as you reinvest it. But the underlying business is growing at a 10 to 15% per year. This also means that the dividend is going to grow 10 to 15% per year. So you can combine these numbers and think of the entire growth which we can expect, which will be between 20 and 15%. That will be your expected return for the next 10 years. per year. So keep that in mind. However, the bonus could be that there will be a potential multiple increase. So the price to free cash flow that I mentioned, I think for this type of business, people in the future will be willing to pay more in this industry because it's safer, it's less uncertain than all the other companies. Like you can compare the financials from a Shell to this one over the past 6 months, and you will see the difference that it make. Sure, you have less potential upside because there's no exploration, but the risk it reduces by the way they run their business is great. So I can see this the multiple like easily in the next 5-6 years increase from 3 to 6. The moment DGOC gets more known, their business model will be more appealing, I think. And I think it could go even further than that, but that is my minimum thesis, and that means that the growth that you're expecting, 20 to 25%, well, don't double that, but double the end result of that, and that could be the end of the share price. So 6 to 9%, I'd say it could be a 10-bagger. DGOC could very well be a 10-bagger. So 10 years from now, you will have 10 times what you invested right now. I do see that happen, and yeah, a dividend yield, even if it doesn't happen, a dividend yield beats the expected market return of the next 10 years. So all in all, it's looking very good. So these are the 15 reasons that I invest in DGOC. As I mentioned before, if you have watched my previous videos, there won't be much new here. But if this is the first time you've seen this video, I highly suggest you check out my other videos, and perhaps you see in DGOC what I see in DGOC, and you have a potential new great investment. So again, I hope you guys like this investment video. I will use this video in the future to reflect upon my investment decision. For example, 3 years from now, let's have another look at DGOC. Did the business grow indeed at 10 to 15% per year? That would be something that I would check. Will the dividend yield hold of 10% plus? With this business model, I believe it will. And 6 years from now, I'm definitely going to look at the potential multiple increase, and perhaps I was right, perhaps I was wrong, and if I'm wrong, I think that's even more important. Then I'm definitely going to look into it and see what mistakes I made in my thesis and in my research, and hopefully learn from it and grow from it as an investor. So that is the idea behind it. You can expect in the future videos like this from my other holdings. I do not have a particular holding in mind right now, but I'm definitely going to make more videos of this, because it's just, I think everybody should keep like an investment journal and write down the reasons why they invest in a company. And I like this way of doing it. I give you a lot of information, maybe a little bit repetitive right now, but for my other holdings you will get a lot more information, new information. You have a potential investment, you get to learn something, I get to teach something. I love it. And yeah, we'll see where we go from there. So if you liked it, please leave a like, and see you guys in the next video.